Hi, welcome back to Budget with me. My name is Josh. So, in this video, I want to talk about why it's important to have a budget when you're going to use Velocity Banking because you need the budget for analysis. Now, in this example, this is a pretty simple budget that I've put together for your monthly budget. Once you do yours, it may look a lot longer than this, but this just gives you an idea that you've got fixed expenses that I do in blue here. So these monthly payments never change. This is mortgage, car payment, your minimums on the credit cards, student loans. Your variables are the things that do change from month to month, like electric bill, water, trash, TV, internet, streaming services, insurance for the cars, um, after school lunches, all this stuff. So the first step in Velocity Banking, once you have a budget in place, and remember what is Velocity Banking? That's a financial strategy to pay off debt and reduce interest as quickly as possible. So what you want to do is take all of these variable expenses that you pay out of the checking account each month, which leaves you with $18 a month in cash flow. We want to put all of these into your credit card that has the highest minimum payment that hopefully has enough credit available to cover this stuff. So if you don't have available credit of at least this 2260 to spend on this credit card right here, then you need to pay one of these down. But in this scenario, we're going to say that just for this video, that this credit card has an available credit of 25,000. So they got $4,000 of credit available here on this card. So we're going to take all these expenses and we're going to assign them to that credit card every month so that it goes to that card automatically. And then we're going to go here. And because the credit card is now taking care of these expenses for us, we want to pay those variable expenses. Plus, we want to have a little bit of principal going towards that, because I'm going to show you the next thing we're going to do. So instead of paying this $481 a month now we're going to pay $2,300 on that card. That covers all the variable expenses plus a little bit of extra principal while we're doing something else here. I'm going to show you. Okay, so that's credit card 2 is taking care of those expenses. Now already just doing that one thing, our cash flow went from $18 a month to $445 a month. Because now that I'm making the $2,300 payment here, the $481 payment originally has already been satisfied with this payment. So that's where that cash flow comes from. Okay. The next step is we got a HELOC, a home equity line of credit. Now, most credit scores require, most banks require a minimum score of about 680 for a HELOC. It just depends on where you go. Some of them you can go down to 660. It just depends. But a line of credit is going to be the most efficient way to do velocity banking and pay off debt fast. So this person, this is just an example. They had this $350,000 balance on their mortgage. And let's say this home was worth about $450,000. So the bank looked at it, got them approved for a home equity line of credit of $39,000. And their interest rate is around 8.75%. That would be a pretty good interest rate for right now. Rates are going to go down a little bit between now and the end of the year, so you might get it for around 8.25. So the reason the HELOC or the line of credit, if you can't get a HELOC, you can get a personal line of credit. These are simple interest based on your average daily balance. So it's going to be the 8.75 based on whatever this is daily, which is way better than your mortgage, which is an amortized schedule. So when you first get that mortgage and you're so happy with that 5% or 4.5% interest rate you may have, about the first 11 to 12 years is mostly interest that's going back to the bank. So if you were to pay your whole mortgage of 30 years, you're actually going to buy your house twice. So you're buying your house plus you're buying another house for the bank. So we don't want to leave your mortgage in place like that for 30 years, but it's going to be the last thing that we attack because it's our biggest line item on the budget. Let me talk about this ranking real quick. The cash flow index. Cash flow index is a way to rank which one of your debts versus your minimum payment gets you the most bang for your buck if you were to pay it off in terms of cash flow. I showed you how we got this 445 cash flow by eliminating this 481 payment and moving our variable expenses to that card. So because of that, our cash flow index went down to 9. Anything under 30 or under 40 or so, like you get a number of, let's get rid of some of these decimal places real quick, make it easier to look at. That's enough right there. So any number that's under 40 is a good indicator that you want to pay it off because you're going to get more cash flow back for paying off the debt. And since we have our HELOC here, what we're going to do is we're going to keep this payment here, the $2,300 for our variables, while we're working down the HELOC, okay? Because with $39,000, we can afford to move both of these credit cards into this line. Okay, so when that happens, we pay these off. Now our cash flow is $1,431 a month left over, and we're still paying the mortgage. We're still paying our credit card for the variables. We're still paying this credit card right here. So now our HELOC balance would be whatever that was. I think it was $33,800. I didn't look at it, but that's our new balance on the HELOC. So now using the $1,431, you're going to attack the HELOC balance every month. Okay. So every month you've got about this $1,400 that goes back into the line, and then you pay your average daily balance of interest. And I've gone over how to calculate the interest in a previous video, but we'll do it again later. But that's why your budget is the most important thing for the analysis. Cash flow index is how you rank which one to pay off. That's how we decided that we should pay off that credit card, these two credit cards, and then it goes into here. Once we've paid this down, the next thing we're going to grab is this balance here. So as soon as we've paid this down enough that we can absorb this $7,900, then that goes in here. And then this payment goes away. And now we're paying $1,800 a month back into the line because that credit card is satisfied. Oh, and I messed up earlier. We moved the car and the credit card one into the HELOC. So we got rid of that $610 car payment in this. So maybe this car here was, still had 4 years left on the loan payment. And maybe it was, like a 3% or 3.5% car payment loan. We moved it to the 8.75 because we gained that cash flow by putting it into this. But we're going to stop there, and I'm going to bring up another video in a minute. But thank you for watching. If you like what you see, please like and subscribe. Have a good day.